161 metric tons. Just try to picture that for a second. That's the amount of gold at the absolute center of this entire scenario. It's a shocking number, and it represents the seizure of a country's entire sovereign reserve. What we're about to do is walk through a forensic war game of a potential geopolitical flashpoint, a really high-stakes play on the global stage. And it all kicks off with this one number. Okay, so let's dive right in. The source material for this analysis lays out a really powerful idea from the get-go. This hypothetical raid on Venezuela, it's not a simple resource grab for oil. This is a margin call. It's all about seizing the one asset that can instantly backstop a failing currency in a global system where government debt is really starting to creak at the seams. We're going to explore exactly how this works, why the timing is so critical, and what it signals about the future of money itself. Welcome to Bullion Signal. Our whole mission here is to find the signal in all the noise of global finance. And if you're here to understand the deep mechanics behind headlines and potential events like this, you are definitely in the right place. Our community of people who want to understand these deeper currents is growing every day, and we're glad you're here. Go ahead and subscribe to join the conversation. Now, let's set the stage for why such a drastic scenario could even be on the table. To really get why a major power might resort to such a desperate move, we have to pull the lens back and look at the bigger picture. We are not living in a stable financial world right now. The foundations are cracking under the immense pressure of sovereign debt, stubborn inflation, and rising geopolitical conflict. So this isn't some random act of aggression in our scenario. It's a calculated, almost predictable response to these deep systemic vulnerabilities that are getting close to a breaking point. Here's the core of the problem, put into a single number. The United States is running a staggering $2 trillion deficit. Some analyses even suggest the national debt is growing at that rate every 6 months. Now, this isn't just an accounting issue. It's a ravenous appetite for capital that puts a huge strain on the entire financial system. A government that's this deep in the red is forced to make choices it otherwise wouldn't, choices that can start to look a lot like desperation. And this chart really tells the story. The debt isn't just big, it's accelerating, it's going vertical. This kind of trajectory creates a systemic vulnerability. It puts enormous pressure on the US bond market, which has to constantly find new buyers for all this new debt. So what happens when confidence in those bonds starts to wobble? Well, the government needs another asset to back its promises, a real, tangible asset. And that's where our story really begins. All right, this brings us to our first pillar, the empire's margin call. We need to frame this gold seizure not as a simple theft, but as a sophisticated, high-stakes financial operation. I want you to think of it like a margin call on a global scale. The empire is broke, its collateral is being questioned, and it needs a real asset to slap on the world's balance sheet to prove it can still pay its bills. This is the cold logic of a repo man, not just a superpower. So why gold? Why not just seize the oil? This slide breaks it down perfectly. Oil is a future cash flow asset. It takes months to get it out of the ground, refine it, and sell it. Gold is completely different. It's what's known as Tier 1 collateral, literally the highest quality asset a central bank can hold. It's instantly liquid, and crucially, it has zero counterparty risk. Its value doesn't depend on anyone else's promise to pay. When you're facing a balance sheet crisis today, you need immediate, risk-free collateral. You need gold. Now, this is where it gets really interesting. This slide introduces a critical concept, a shadow price. The source suggests the Treasury isn't valuing this gold at the daily spot price you see on TV. No, they're using a calculated internal value. In this scenario, it's $4,300 an ounce. This isn't a market price, it's a collateral floor. It's the price at which major institutions are willing to accept the metal onto their balance sheets, and it reveals how they really value it behind closed doors. This isn't some new playbook they're inventing on the fly. The source presents this as a kind of standard operating procedure. First, you identify a nation outside the system with a big stockpile, in this case, Venezuela's gold. Second, you create a public pretext for intervention. Third, you execute the seizure with military force. And finally, step 4, you repatriate the collateral to a financial center like New York or London. We've seen versions of this same pattern play out before in places like Libya and Iraq. Okay, so that leads us right into our second pillar. And this one is all about timing. This raid wasn't just a random smash and grab. It was a preemptive strike, a financial interdiction, really, designed to neutralize a very specific geopolitical and monetary threat. The United States, in this scenario, wasn't just grabbing an asset, it was stopping that asset from being used as a weapon against the dollar by a rival alliance. And this timeline puts the urgency into really sharp focus. According to the scenario, US intelligence gets wind of a plan in late December. Now, look at this. On January 10th, a meeting is scheduled in Shanghai to officially pledge Venezuela's gold to the BRICS alliance. That created an incredibly narrow 7-day window to act. The raid on January 3rd wasn't just an attack, it was designed to kick the door in before that wire transfer could clear. So, what was this big threat they were trying to stop? It's called the BRICS unit. It's a proposed new currency for trade, but with a crucial difference. Unlike the dollar, it's not backed by debt. It's backed by hard assets, 40% gold and 60% commodities like oil and copper. You see, that design makes it a direct competitor to the US Treasury market by offering the world an alternative to a debt-based system. And that's why Venezuela was so important. Those 161 tons weren't just another drop in the bucket. They were the keystone. Pledging that much gold would have provided the critical seed capital to legitimize the new BRICS currency, right here in the Western Hemisphere, giving it instant global reach and credibility. By seizing that keystone, the US didn't just hurt the project. They sabotaged its very foundation before it could even be laid. This whole situation brings up a huge question, and I'd really love to get your take on it. We've talked about internal debt and this idea of a new asset-backed currency from rivals, but what do you believe is the single biggest long-term threat to the US dollar's dominance? Is it the debt, a rival currency, general de-dollarization, or maybe something else entirely? Go ahead and share your perspective in the comments below. So the repo men have the gold, but now they have a massive logistical problem on their hands. How do you take 161 tons of dirty gold? I mean, it's heavy, it's traceable, it's legally toxic, and make it just disappear into the global financial system without crashing the price or setting off every alarm bell on the planet? In this third pillar, we're going to explore the sophisticated accounting magic that could be used to launder a nation's wealth. So here's the technical problem they're up against. Physical gold bars are not like cash. They're not fungible. Each one is stamped with a serial number, a refiner's mark, and the year it was cast. These Venezuelan bars are legally radioactive. If you tried to sell one on the open market, compliance officers would instantly flag it as a sanctioned asset. So, in its current form, this gold is basically unusable. The solution lies buried in the system's plumbing, in something called unallocated gold accounts. Think of it this way. Instead of owning a specific numbered gold bar in a vault, you own an IOU for gold from a general pool that a bank holds. It's really just a ledger entry. This seemingly small distinction is the key that unlocks the entire laundering protocol. It separates the physical, dirty asset from a new, clean, digital claim. And here's the 3-step magic trick. First, the physical Venezuelan bars arrive and are tucked away into deep storage. They never see the light of day again. Second, the vault operator simply adds the weight of those bars to their general inventory on paper. And third, they issue brand new, clean, unallocated credits. These are the paper claims to the US Treasury. The dirty bars sit in the dark, but clean digital gold has just appeared on the books, ready to be sold. But wait, someone has to buy all this new paper gold, right? Well, according to the source, the buyers are large ETFs. When the Treasury sells these newly created unallocated credits into the market, they're effectively using the constant river of demand from retail investors as their exit liquidity. So in this scenario, everyday people think they're buying a safe haven, but what they're unknowingly doing is funding the operation and absorbing the laundered asset into their retirement accounts. And look, if that whole paper shuffle isn't enough, there's always Plan B, the physical cleanse. The bars are quietly flown to sophisticated refineries in Switzerland. There, they're melted down at over 1,000 degrees Celsius, which completely erases their history and serial numbers. They're then recast into brand new bars, stamped with a Swiss logo and a new date. The gold is now virgin metal again, its toxic origin completely gone. Which brings us to our final pillar, and honestly, the most devastating consequence of this entire operation. The gold has been seized and laundered. The BRICS threat has been delayed for now. But the cost of this victory is catastrophic. In this fourth pillar, we're going to examine the permanent damage done to the most important asset of all, global trust in the United States as a safe place to store sovereign wealth. This quote from the source material just hits the nail on the head. You can get away with a heist like this once. You can achieve a short-term goal, you can plug a hole in the budget, you can neutralize a threat. But what you cannot do is force the world to trust you again. This action, in our scenario, represents a massive short-term gain for a permanent, irreversible loss of credibility on the world stage. What this really means is that the long-held principle of sovereign immunity is dead. Every central bank, from allies to adversaries, is now on notice. They're all looking at their own gold reserves stored in New York and London and asking themselves a very simple question. Are we next? This is what triggers a global run on the bank, not by individuals, but by nations, all demanding their physical gold be sent home immediately for safekeeping. And that's the crucial point here. This move is incredibly short-sighted. It sacrifices the very foundation of the global financial system, which is the trust that the US is a neutral custodian, all for another year of solvency. It's basically the equivalent of burning your furniture to stay warm for one more night. Yeah, the lights might stay on, but the house itself, the system of trust that was built over decades, has just been burned to the ground. Okay, so we have walked through the entire crime scene. We've looked at the motive, the method, and the consequences. Now we're going to pivot. We're moving from explaining the problem to providing a framework. In a world where the rules have fundamentally changed, how do you navigate this new, more dangerous environment? This next section is all about translating this geopolitical scenario into actionable signals and strategic thinking for your own risk management. Let me just ask you this directly. This scenario signals a massive shift from a world that was governed by the rule of law to one governed by, let's call it kinetic forfeiture, where if you can't physically defend it, you don't really own it. In a world like that, where the old rules of property don't apply anymore, how do you adjust your strategy? How do you position yourself to protect what's yours when the global policeman becomes the repo man? All right, rule number 1, according to the source material, you have to reevaluate paper gold. As we've discussed, ETFs are the most likely exit liquidity for this kind of laundered metal. Paper claims carry huge counterparty risk and could be frozen in a legal battle. The source argues you have to own primary assets, which in this context means allocated physical metal. We're talking about coins in your hand or bars in a private non-bank vault that you can actually verify are yours. Okay, rule number 2 is all about thinking one step ahead, front-running the retaliation that's bound to come. China isn't going to take this lying down. The logical response isn't military. It's a supply chain counterattack. You should expect strategic mineral embargoes on things they control, like rare earths and silver. This means considering exposure to those commodities, and critically, to miners operating in safe jurisdictions like North America, who would become national security assets overnight. And rule number 3 is maybe the most practical one of all, the calorie hedge. The seizure of Venezuelan oil in this scenario would create a ripple effect, specifically a diesel shortage. If the trucks stop running, the food stops moving. The source suggests the best investment might just be a full pantry. Securing 90 days of essentials isn't about being a prepper. It's about supply chain arbitrage, buying life's necessities at today's peace price before the market reprices them at a war price. So instead of just guessing what happens next, this slide gives you an actionable dashboard of signals to watch. You can monitor the data. For example, if you see a sudden, unexplained spike in Swiss gold imports coming from the USA, it could be a signal that the physical laundering has begun. In the same way, if you see accelerating outflows of gold from the New York Fed's custody accounts, that's a signal that the sovereign run on the bank is picking up steam. Okay, let's bring this all back home and close the loop. The central idea of this entire analysis is that the seizure of 161 tons of gold wasn't an offensive act of imperialism. It was a defensive act of monetary survival. It was the desperate move of a system that's been backed into a corner, one that's willing to break all the rules just to keep the lights on and preserve its failing currency for a little while longer. And this brings us to the golden nugget, the one memorable line that really summarizes the new paradigm we might be entering. If you can't defend it, you don't own it. This applies to nations, and it applies to individuals. The age of just relying on paper promises and the goodwill of distant institutions, that might be over. The era where physical possession is everything has likely begun. So the final warning is this: the repo men are out there, and they are just getting started. Now, it is really important to remember that this has been a forensic analysis of a hypothetical scenario. It is absolutely not financial advice. Our goal is to give you a framework for thinking about risk, so please always conduct your own due diligence before making any decision. I want to leave you with one final thought to continue this discussion. We talked about watching Swiss gold imports and New York Fed outflows as key indicators. Of all the signals we've discussed today, which one will you be watching most closely as we move forward? Let me know in the comments. Thank you for joining this analysis from Bullion Signal. Stay vigilant.